Hi, this is Randy Finney with the right side of the chart, and today is Wednesday, November 8th, 2023. It's 12:40 p.m. Eastern Time. So I'm starting the video, and this is video number 2 for the day. Got one out to you earlier covering the broad markets, and I just wanted to do one more. I wanted to keep talking about the longer term, my longer term outlook and longer term price targets. But I realize it's been a while since I've really focused just on the long term outlook of the equity market. So here's what we're going to do in this video. We're going to start with just we're going to stick with just long term time frames. That means to me weekly and even monthly charts. Right here we're looking at a monthly chart of the SPY. And what I mean by that is if I refer to a chart as a weekly, monthly, daily, I'm referring to the period of each candlestick. So on a monthly chart, every candlestick represents 1 month of trading. And I can tell you this with as strong a conviction as I have on anything, the same basic premise of technical analysis that work on 60-minute charts and daily charts. In other words, trend lines, support resistance, divergences among price and the momentum indicators, key moving averages, how stocks behave off that, bullish and bearish chart patterns. They work just as well on the longer term charts as they do on the shorter term charts. The only difference is they take a lot longer to play out. If you're analyzing a monthly chart or a weekly chart, and you're looking for a move, let's say I have a bullish chart pattern or a bearish chart pattern or divergences or something, then you're looking at a move that's likely going to be measured in months and well into the double digits, whether it's a bearish trend or a bullish trend you're looking for. So let me dive into the charts here. And there's also, I'm noticing something unusual today. It's seemingly unusual. It's not really being reflected too much in the indexes, and that is some things going on with the small caps today, which I'll get to towards the end of the video. And we're just going to take it down by market cap. So we're going to start out with the large cap indexes, which are the S&P 500. I'll get to and the NASDAQ 100, the big ones. I'll get to the mid caps and then small caps. So on a monthly chart, which we're looking at here, a SPY, you can see these are levels I've had here. I've marked this chart up a long time ago. I measure out, or I'll show you. You can see at quick glance. Again, this speaks to what I was saying earlier about the same things we look for: divergences, trend line breaks, support resistance breaks, and things like that. They hold true. So what I have circled here are all the divergences in on the monthly chart of SPY going back into really since it came out. Looks like that ETF was launched in the mid 1987 or something like that, late 87. And so there's the measurements here are the move off. That was off that divergent. There was a divergent high here. I need to actually, I don't know why that's not there, duplicate. That was really what I call DH1, when you have consecutive divergences that really stem from the same point. It's really DH1 and DH2. The second divergent high is just larger, the same divergence extends. So it was a 23% drop, shot across the bow. For those of you that were around then, like I was the Asian contagion, they called that back in the mid-90s. It set the markets off. And then these are the two, in my opinion, the only two bear markets in recent history, in decades, and that is the dot-com bubble, which popped in March of 2000 in the NASDAQ and then took the S&P down about 51%. Also took the NASDAQ itself, even the NASDAQ 100, down around 85%, because, again, it's that tech concentration I talked about in the earlier video today. So usually the S&P 500 in a bull market is going to go up less than the tech-heavy NASDAQ, and that's simply because tech companies are higher growth. They have higher growth rates, therefore their stocks tend to grow at a faster pace than your steady Eddie, chock full of grandma stocks in here in the S&P 500. You got dividends, paying blue chips and utilities and healthcare, defensive issues, and all that good stuff that you don't have a lot of in the NASDAQ 100. And then the last bear market to October of 2007 to March 09 right there. And those are the drops, 51 and 57%. And then along the way, we've had corrections ranging usually, the media and the old definition, which I think is antiquated, is a drop of 10% or more. Again, I'm just measuring the moves off the divergent highs. It was DH1, 20% drop, DH well, there was actually DH2 right here. Yeah, I'll zoom in. I sometimes forget that some of you might be watching this on your phone. That was actually first divergent high, 20% drop. Another one leading up into COVID. This was the Q4. I call it the Q4 2018 drop. We caught all that short, got long at the bottom, bounced. Fed had a pivot right there. They started to try to take the juice away from the markets, meaning the free money, the zero interest rates, and then quickly learned the market cried foul, and they gave them back what they wanted. And then so that led us up, another leg up. COVID took us down 36%. And then, so here's where we're at. We've come full circle. DH2, this is a big divergent high on the RSI down here. You have RSI divergence. And so far, I guess I've measured that. I just moved it, so now it's going to say updated today. That would have been in October. Let me just see. No, July. I'm sorry, it said July. Let me just measure it here. Yeah, about 27, closer to 27%. And so here we are right there. This is our uptrend line off the lows, breakdown back test. And so again, I view this, continue to view this as the first leg down. And it's a lot cleaner when you just take a step back and you look at it on this weekly chart. You can see the trends more clearly. I have note here to see board 4. There it is. So these are my longer term trend targets, and I have not modified these. These are targets. I made this one back in May of 2022. And then this ITGU, that's if things get ugly target. And the second target down here around 215. From current levels, that would mean a drop. If my monthly first targets hit, about 25% drop from where we are. Second target would be about a 50% drop. And if things get real effing ugly, target 3, final death of the great secular bull market, and end of the, should be an N, of the Great Recession 2. Put your guns away and buy anything with a ticker. And that would be from where we're at now, if that target gets hit, 63%. And I know, I'm sure most of you think I'm crazy, but I think there's a decent chance of that happening again, based on my longer term macro outlook, based on the secular bull market and interest rates having just begun, ending a nearly half-century downtrend, bearish trend in falling rates. And then, of course, everything else going on right now with the financial system, currencies, the debt load. You've probably read up or heard some of this. The U.S. is carrying the biggest debt load outside of a debt to GDP ratio outside of wartime. We're not even in a war. Everything's hunky-dory, and yet we have this explosive debt, which leads really just no room. What happens if and when the next recession comes and it's really bad, or God forbid, World War III finally does break out or anything like that. So anyway, all right, I don't mean to sit here and be doom and gloom. We'll take this day by day. Nobody, including me, is going to short here today and hold everything to down there. But what I'd like to do, bigger picture, especially in longer term accounts, that was that little uptrend line, by the way, I had there. So you can see here from this perspective, SPY is, we just broke below the uptrend line there, and we're still below it. And, see something along these lines, game it, the bigger trends this way. In any secular bull or bear market, there's always going to be counter trend moves. In other words, what does that mean? A cyclical bull or bear, that's what these were. These two bear markets that I mentioned back here, the last two real ones in 2000 to 2002 right there. I'll box that in. That one, and then the one from 07 to 09. Those are called cyclical bear markets, but within a larger secular bull market, okay? Nothing lasts forever. So, like Japan did in the starting around the early 90s, entered its, the lost decade, they call it. It's really 2 decades of negative stock market returns. I think that's coming around the corner. Obviously, if I'm right, it's going to have huge implications for your investments. for the whole everything, the financial industry. That's where I come from originally, and they're, the wirehouses, investment companies are geared towards always put money in stocks. Don't try to time the market. Stock market always goes up, and because you're coming off again decades where that has been the case. It's been a long time since a true secular bear market. You can see here this cyclic. The secular bull really started back here. We had the market was kind of going sideways, called a deer market, with some big corrections along the way, or cyclical bear markets back in the 60s to 70s. And then the S&P 500 broke out right here. There was the breakout back test after years of consolidation. Again, bull and bear markets going sideways. And then this is that whole great secular bear market that I'm talking about. Bull market, that I'm talking about. Okay. Let's just step it down back to the weekly chart. Take a look at some targets. That's the S&P 500. Let me go to SPY, then I'll get to QQQ. All right, so these are, I'm going to zoom in here. I know it's a busy board. I don't mean to get you dizzy by zooming so fast, but this was near-term first target. Again, these were targets calling for the bear market here, getting short in and around the highs when the markets peaked. Again, the bear market officially kicked off right in the beginning of January 2022. That's when the S&P topped. NASDAQ peaked a little bit before that in November. And I laid out early on in the whole thing, I laid out these targets here. Near-term T1, which was hit already. We hit, and as often is the case, I think you can see it here. Hit it right there. We bounced. There was the bounce. Nice tradable double-digit bounce. Then my second target was hit right here. Same thing. Nice tradable bounce. You can see it right off T2 bounce. And then those were, again, as the name implies, near term. Now that may sound confusing because I'm usually referring to near-term targets like I have recently with QQQ on the 60-minute chart as near-term targets. Near-term relative to the time frame we're talking about. Hopefully that makes sense. So if I talk about near-term targets on a 60-minute chart, those will probably be hit within days, maybe a few weeks at most. Those are near-term. Now, on a weekly chart, near-term, because every candle's 1 week of trading history, we're talking usually weeks to months, let's say, and then longer term would be months to years. And so that was my long-term, T1 first target. Again, from March, looks like March of 2022, early March, I laid that target out, and we hit it to the button right there. And we bounced, and it's been one heck of a bounce. Now, this is why was it? What's the difference here? Well, long-term T1 is a much more significant support level. So therefore, it was the perfect launching spot for a bear market rally. And that was, these were little ones, and we, don't get me wrong, we gamed all of these, at least a good chunk of them, got out of shorts, or at least it was, the setups were posted. And now this was a much larger one. Given I underestimated the magnitude and the power of it, but it doesn't surprise me, even from what I was talking about back here. I said that early on, before this bear market even started, before anyone even talked about it being a bear market or that we were going to have one, I said the next bear market, in my opinion, was going to play out, and I still believe this, much, much different than from those in recent years. In other words, that's that map I keep talking about in my head. A more of a secular multi-year bear market, not the bear markets of yesteryear. I don't consider COVID, even though it was a 36% drop, a bear market. I call it Ursa interruptus is my term for it, a bear market that was interrupted. I think we, by all means, would have had one had both the Federal Reserve and Washington not taken such drastic steps over juicing the markets. But whatever. These are corrections. Fourth quarter 2018, a correction in my opinion. The last true bear markets, again, were just secular or cyclical bear markets, and they were powerful. You felt them, but those were back again, as I covered earlier, 2000 to 2002, and then 07 to 09 right there. Okay, so the way I see this thing playing out is a much slower, bigger waves, because again, when you look back at what we were starting, and you look at the, just look at the magnitude of the bull market. This bull market that we're looking at, secular bull, And again, I've talked about this so much, but if you're new to the site, it bears repeating. If you think it's mere coincidence that bull market coincided with this largest secular bear market in interest rates. This is that 10-year treasury yield I'm talking about. You could put the 30-year up. Again, there's no mistaking. This is Economics 101. This was my background as a business major in college, former financial advisor studying the financial markets. This, again, it's Economics 101. Rising rates stifle economic growth, lead to recessions or economic contractions, or at best stagnant and little growth. Falling rates are very bullish for the stock market and for the economy, for the obvious reasons. For the economy, lower cost of capital. For the stock market, several reasons, including how businesses are more profitable. But there's also the alternatives. Back here, when you could get on a 10-year bond 15% all day long, and a lot of people would do it. And there's no set point where everyone moves all into bonds out of stocks. It's incremental. And so as rates went down over the past 40-something years, incrementally, more and more individuals and institutions shifted into stocks. It wasn't worth it when you're getting 3 and then 2% on locking your money up for 10, 20, even 30 years, when you could get better than that on dividend yields on stocks, plus the stock market was doing well. So that siphons money away from bonds and into stocks, and the reverse happens here. And if you look at this, relatively, again, relative to the move, which is, like I said, that was rates peaked back in the early 80s, and that was 42 and a half years ago right there. 1981, I think it was. Yep. This has happened so fast, and this is the big buzz now. You hear about the lag effect, and so far it's the bulls are saying, oh, look, the economy is so strong it was able to absorb this rise in rates. But if you look at how fast it's happened since they bottomed in COVID, it's only been I'm going off the COVID lows when rates bottomed out 3.5 years. Over a span. This took years. So this is so fast and so strong, and we all know there is a lag effect. That is a known thing when rates go up or down before their benefit is felt and trickles its way through the economy, through corporations. And one of those reasons is corporations, like individuals. I haven't been affected by this. I have, my mortgage, I was locked in before that. I don't have any car loans, but even if I did, let's say I was driving a car that would, that I bought, or leased a few years ago, and that then it would be a problem if I were to have to get a loan for that car. If it was my lease was coming due, or I decided to sell the car today, I'd be looking now probably at 9-10%. I don't even know what car rates are. So that happens as well. We know this. These numbers are there. There's a tremendous amount of debt, corporate debt, that is locked in at those low rates, will be coming due between now and in the next couple years. And that's where, if rates hold up here or happen to go any higher, it's going to have a huge impact on those companies. And as towards the end of this video, I'm going to get to the small caps, because they are the most sensitive to interest rates, because they are the smallest companies. Their credit is not, they don't have the same credit quality. Apple can borrow money at very cheap rates because everyone knows that they're a cash cow. They have a ton of cash. They don't even need to borrow the money. The only reason they do is because they can. They started selling bonds a few years back. At the same time, they had more cash than they know what to do with. Why? Because they could. Why not? If you can borrow money at 2%, turn around and buy your stock back with it. And that's what they've done. They've used those, issued a lot of debt, and a lot of that money has gone to finance their stock repurchases. Okay, so if and as this plays out, time will tell. I've shared my thoughts quite a bit lately with this primary uptrend line here, some negative divergence. The charts indicate a pretty good likelihood of a correction in rates, which, as I've talked many times, should be net bullish for stocks, but not it doesn't have to be a bullish event. Or in other words, even if it's net bullish for stocks, because of falling rates, That doesn't necessarily mean that they must go up, because if there's other problems going on, such as sharp earnings drops due to recession and other problems like that, then stocks can still fall, and we can see interest rates fall because various forces, including but not limited to institutions moving money into treasury bonds, because when you buy a bond, it puts upward pressure on the bond prices, which in turn put downward pressure on the yields. Okay, let's get back to the stock market and go through the few indexes and then wrap up with the small cap. So there's SPY on a monthly. Let me just see, covered a couple different boards. All right, and there's my weekly chart. I know it's a little bit busy. I'm zooming in and out. I apologize for that again. If it gives a dizzying effect when you're watching it on YouTube. But there's our, I have two trend lines. They're parallel trend lines, or roughly parallel. That one, you can see lots of key reactions. That's why I have both. Lots of reactions from here, major reactions here. COVID, you had that spike through, and then you had another spike through down here at the end of the last bear market. And that's the first one to watch. And that was, I believe, that aligned with my first long-term target. LT2 long-term second target is about 339 or so. If hit, that's going to mean from where we're at today, a drop of about, and you can see it comes in, it should come in roughly with that secondary uptrend line. That's about a 22% drop. And then LT3, and I'm going to add it right now, LT4. Might as well do it now because long-term fourth target. And I'll just make a note here. 11/8/23. Oops, there are a couple little typos there. Quite a few. Okay, I'm trying to look at the. If I don't look at my keyboard, I make typos. All right, so that would be down, down to about 300, and that would take us down roughly about 31%. Actually, no. This is where I think longer term, and I'll just put it now. Longest term, where I think we're going long term, T5, and let's see if I can do this a little better this time. There we go. All right, so that's kind of bigger picture. We'll see if we get there or not. Zooming in, this is also the weekly chart. This is a different board to kind of recap what's happened recently. The lows back in October of last year came on a divergent low, aka positive or bullish divergence, and a bullish engulfing candle. That means this candle right here. No, that was on the daily chart. Okay, some of these things are showing through. Here we go. Yeah, they're showing through on a daily chart. I have to go back to this board. There it is. You can see on the daily now. So these were the same. They just showed through. We're on a weekly chart, but I was on board number 8. You can see it down here. And so it showed all my annotations from this board, which I created on the daily. That's that big old bullish engulfing candle. Those are really nice to look for when you're in a strong downtrend. You get a big washout move, and then so at some point you've put in a new low in the bear market or the correction, and then you see a strong reversal only to close positive, and that candle, the body, the fat part of that candle, needs to engulf at least the previous candle. In this case, you engulf the previous 3 red candles. So great, bottoming stick. And then you just need to, at that point, the strategy is easy. When you see them, if you recognize it, I tell you, you won't want to buy right then. Everybody's super bearish when those are put in. But the strategy is easy. You buy, go long, and you put a stop below the bottom of the candle, because if we go below it, then it's no longer, it must be on its own. You cannot have a violation after it. Doesn't guarantee the market can't go up there. It just means that you don't have a bullish engulfing candle. Fast forward to recently, and we had a divergent high. Everything that we had in October 15th, but in reverse. A divergent high and a bearish engulfing candle. You can see it engulfed the previous 1, 2, 3, even 4, maybe even 5, all 5, possibly all these, at least those, and that's all it has to do is engulf one. The more the better. And one thing that does is a lot of people tend to buy in at the highs, especially the what they call the dumb money, the retail crowd. And so all those people in one fell swoop get wiped out. A lot of stops get taken out. All the buyers in the last month or so got wiped out in that single weekly candle. And then the dip buyers, as they do, stepped in, but they failed to take out the bearish engulfing candle. So that did mark the top, and this is the downtrend we've been in since. The million-dollar question: is it over or is there more? Here's an alternative trend line I have right here, the downtrend line on SPY off the highs. And then I also laid out for you before it broke down, and then after the breakdown, this head and shoulders topping pattern. You had a beautiful left shoulder here, head, right shoulder, neckline, breakdown of the pattern. If you missed the breakdown, then you had an opportunity on the back test, and then the biggest, that was one of the biggest drops in really in months, right there. Perfect hit. And I also highlighted it at the time, the reason for covering shorts and going long, because the measured target for the head, and it was a perfect tag of that measured target. And now look where we're at. We're back testing the neckline again, and then you have downtrend line resistance above it. Okay, and I'm just clicking around my various boards. Here's a weekly chart with a bunch of fibs on there. You see all these colored lines. I have this blue one that measures the entire bull run off the March '09 lows. And so blue, you look at these blue lines. I have the measured move from the COVID lows all the way to the recent highs in yellow. And basically what I have here is a Fibonacci cluster. That's when you put up these fibs from key points, various fibs, Fibonacci retracement levels. I have a cluster here of the 32.8 retracement of the entire bull market, again off the March of '09 lows, this cyclical bull within the larger secular bull. And that would be when we get there, and it is my next bear market target on this board, and it does line up with other targets I've given you on, from price levels. And that's the 61.8 retracement of the move up from the COVID lows. And so neither of those have been hit yet. In fact, we had a cluster right here. If you can see it, it's hard to see in the video. There's two perfectly overlaying lines. The purple line right here. Oh no, wait, I'm measuring off the lows there. Disregard. But we did have a 50% retracement of this move right here. That's that yellow line that was hit. I just happened to add another fib to look at this counter trend rally, which stopped at the 78.6 fib. Okay, so that's the next target based on Fibonacci retracement levels, that fib cluster. And let's move on now to QQQ. QQQ, again, my typically go-to index, reason being, you're either going to, or I'm either going to be right or wrong on my call on where the stock market's going. So I'd like to get paid for it. And typically on a rally, QQQ is going to go up more than the S&P 500. And in a bear market or correction, it's going to fall more due to the fact it has a higher concentration of growth stocks. Simple as that. T1 hit right here, bounce. T2 hit right here. Again, these were targets all laid out back in the very beginning of the year, right before anybody knew there was a bear market coming. We were in one. That was on January 5th, 2022. T2 also created there, hit. T3 also created on January 5th right there, and that was hit. And did I give you T4 back then? No, I created that right afterwards on January 20th. I added that one, and that has not been hit. So we've seen check, big bear market rally off T3, which also coincide with the price target on SPY. And again, so now if this plays out the way I think it would, we're headed down. I have T4 as either the 235 level or the blue trend line. Now, when I listed that target, that's because in my mind's eye, that whole roadmap, game plan I had, I saw it going down like this back then. And so what happened is this one, we had a much larger bear market rally than I thought we would off T3, again, before we even got down there. So now we're not going to hit, the blue line comes in first is what I'm trying to tell you. And the blue line is an alternative trend line. You can see as I scroll back here, It starts at this point, and you have a lot of reactions. That's why I have it on there, starting back here, multiple reactions. And but price wise, I do think we come on down here to 235. So I'm still going to maintain that as whether or not we get a reaction on the trend line or not, 235. And that's going to give us on the NASDAQ 100 roughly 36% drop from where we are. And then this somewhere down around here, I may add an additional target. By the way, that T4 is the pre-COVID highs. A lot of my targets on a lot of these charts line up with that. That's also LT, long-term T2 right there on SPY. So I just wanted to mention that. That's what I'm targeting. And again, timing is everything. So we'll try to be, aggressively long or short when the charts are clearly bullish or bearish. And, I'll share my thoughts when, as I always do, I'll point out in a rally, I'll point out objective levels to add to shorts if it looks like we're going to reverse there, or objective levels to go long if we break out above resistance. So we'll try to continue to game, all these what I call squiggles, if you will, the counter trend moves within the larger trend. And this one, like I said, has been juiced quite a bit. And the $1 million question, is it over or not? Again, I've covered that quite a bit lately on the daily charts. We'll see. I don't believe so on the daily. On the weekly and long term. And again, if we're going to reverse, it needs to be pretty soon based on the proximity of this downtrend line on QQQ and SPY and everything else. So there's QQQ. Let's step it down to the mid caps, MDY. Mid caps are a very important sector of the stock market. A lot of the companies are in there. I'll just give you some names here. Let me just sort by market cap and give you an idea. JBL. Oh no, that's Jabil. Deckers Outdoors. There's a ton of companies in here. I'd have to go through the whole list, but a lot of those that you're familiar with. Let me go back to that MDY. Okay, so to just recap it, we had put in back here right when the stock market topped and the bear market started, a clear divergent high. We also had a failed breakout. If you zoom in real tight there, you can see there was resistance. The mid caps are pushing along this level here, and they broke out. And as I often say, fewer things in investing and trading are more bearish than a failed breakout. Just like a failed breakdown is very bullish when you break down and then recover a level. So that's what that was. And the rest is history. I also laid out targets. This is T1 back here, T2 zone, which is yet to be hit, and potential T3. And look, I just added this today for you because that's where I think we're going. T2, you can see the pre-COVID lows on the mid caps are right here. And that's that T2 zone. So I have a pretty good degree of confidence. Again, this target was laid out before many even knew there was a bear market in progress. And I still think it's going to be hit. This has just been I don't cover this one a lot. It's just been kind of doing its own thing. And it's not even a well-defined trading range. I can't really draw any clean trend lines. It's just in this sloppy mix, but it's well off its highs. And I do think we go down here, and that would be roughly a drop of about 16% to that next target. I don't want to spend much more time on that. Let's now jump down to the small caps, and then I'll point out some levels and some developments that I'm noticing today. All right, my busy board on the weekly chart, IWM. Now I just toggled over to the monthly. Let me start on the monthly. It just kind of shows the big picture pretty clear. Sometimes these little lines get moved or go away. I don't know why. So here you can see we had a nice price channel. This is going all the way back in the early 2000s. There was an uptrend, divergent high, broke, bear market, ended in 09, divergent high, correction, divergent high, correction, divergent high, correction. Equal highs, so still divergent high because the indicators kept diverging, negative divergence, and then COVID hit. Divergent high, and we are in a bear market, which is showing zero signs of that bear market being over. You think what you want, I think what I want. One of us will be proven right and one wrong if you're bullish and I'm bearish. What I see is a very, very good support level. and I see an initial leg down, and then just consolidation. And so IWM has a much clearer chart, in my opinion, than the mid caps. And again, IWM is the small caps, Russell 2000 small cap index. That's the best trend line I can do. It only has 2 reactions, 1, 2, but it's probably going to come into play. However, I feel pretty good that this will be hit. This is about 129 right there. That's my next target based on this monthly chart that we're on. And so maybe overshoot this a little bit, back test, I don't know, come back on it. Even if we overshoot, remember this is a monthly chart, but that is my next target right there, 129-ish right there. And then if things get really ugly, this is where I think it takes us. So what does that mean on the small caps? They have about 24% to that next target. And if things get real ugly, about 40 to 50%, 45 to 50%. Okay, back to that weekly chart. I'm going to zoom in a little bit. So there's that secondary trend line. And these are my targets here. T4 is right here. So that was the divergent high, failed breakout I talked about. You can see the trading range right there. And then when we broke the bottom of that trading range, that was really good support there. Look at all that support there, about 209. We broke it, hit my first target, and bounced. Where did we bounce to? Remember, support, once broken, becomes resistance. And so we bounced right back to 209, tested it for several weeks. Bulls couldn't pull it off. Plus, we fell below, see the 200-day / 40-week moving averages, the blue and red line. Also took those out, back tested those. It was a beautiful short entry, re-entry, short entry. And then all along, you can see the 200-day moving averages right here. The red, I have the 40. Again, I refer to them as 200-day because on a daily chart, it's the same thing as on a weekly chart. Use a 40 period, 5 days in a week. 5 times 40 equals 200. And there's the exponential 40-week, aka 200-day moving average. And you can see here, they were support. They got taken out, and collectively they've contained. There was a couple weeks here where you traded above them, but then the small caps lost that again. Took it out again, but failed, and we're back below them right now. So they've moved through there, but that's just a function of the small caps being in a trading range. And I always say this, moving averages, don't put too much weighting when you start locking into a trading range. You're going to move through moving averages. So really, if 2, 3, 6 months from now, we're clearly below them, then you can say, okay, we're clearly in a bear trend. We're well below the 200 days. But what I can tell you much more important right now than the 200 days is this trading range I'm boxing in here. I mean, come on, look how many reactions at that level. That was also T3, third target there. Multiple reactions, including this one recently. So, and again, I can make one of the most, and I have. 2 weeks ago, I started making a very bullish case. Cover shorts, go long, and I can still make that case technically. But like I said, I'm kind of overriding a little bit, or I'm a little suspect, if you will, of all these bullish divergences and successful defenses of support and key moving averages recently, because that's the signature of a bear market, is to suck in the masses. And I've seen it in previous bear markets. Give you some textbook looking bullish setups, make it look like to both fundamental guys and gals as well as technical folks, meaning technical analysis, make it look like the bear market's over and it's going to rally. And just when the rally starts to get looking really nice, boom, that's when the bottom falls out. So it hasn't yet. This is all I can tell you. 100% certainty that this is good support. You can see the levels there. And so if and when that goes, especially if this positive divergence that I'm drawing right here, we have equal lows all across, maybe even a slightly lower low. Doesn't matter whether they're equal lows or lower lows, as long as the indicators are making higher lows, that is still positive, aka bullish divergence. And so if we smash down through there and these indicators take out the previous lows, you no longer have the divergence, and that's when things get pretty ugly, because that's when the technical folks can't make a case to be long the small caps anymore, so they throw away their longs, they start shorting, and that should take us down to T4, and I would give it what I call a high degree of confidence we're going to bounce there, just like most of my targets. You have the intersecting uptrend line and really good price support, about 144 20. Why is it good price support? Well, you can see all the reactions back here. Here was resistance. Boom, we break out right there. Perfect back test after the breakout in a strong rally. Came back, bounced again. Did have a brief whipsaw move down through there, but recovered it quickly. And then back test, back test, back test. You can see, so we've traded. There's a lot of reactions on that level. And went down when COVID hit, took it down below there. But then the government juiced the markets and the Fed juiced the markets, and that's what happened. And that's where we are now. So anywho, that's my next target. And to quantify it, for those that may want to just short small caps, hold their nose, jump in, with stops above, but you're talking about 16%. Again, I can't make a very strong case, but I can make a decent case, based on what things I just showed you. Plus, here's your primary downtrend line, right off the highs, which we just ran into, and we back tested this uptrend line. See that one? We have reactions here, here, here. Then we broke it, back tested, so we just hit a confluence of resistance. And so this is really kind of where it gets good. If we can take that level out, it should be a quick swoon down to that next target. Likewise, if we break out above the trend line, we take back the 200s, well, that's probably going to run us up to the top of the range. And with positive divergence, I cannot rule that out. Just can't. It's certainly a possibility. All right, let me show you now. Let me see if there's any other boards I want to cover here. No, that just shows you that trading range. You can see how clear it is. And we're at the bottom of it. So got to be careful. The MO is usually once you hit the bottom of the range, you go to the top. At the bottom, next stop is the top. And when you hit the top, the next stop is usually the bottom. But not necessarily. Sooner than later, all ranges, especially this one's getting long in the tooth. There was a trading range. And actually, that one should have been extended. I guess I drew it there and it got bigger. That was a false breakout. And see, that was very bearish once it failed. Went back to the bottom of the range and pretty quickly after that took out the bottom of the range. And again, it acted as resistance. So watch this one if you're an IWM trader, or even if you don't trade the small caps. I would keep an eye on this. A lot of the regional banks are inside IWM, the Russell 2000. And that leads me to the final thing I wanted to show you in this video. Let me jump down to a daily chart. And what I'm going to do is load I have a watch list. It's not on the screen right now. Here, I'm going to bear with me. Okay. Here, I'll show it to you if you want to see it. This is what I love about this charting platform. You get the components of any ETF, any sector ETF, index ETF. So there's nearly 2,000. It's actually, if you can see just down at the bottom, I don't know how good your eyes are. It tells me there's 1,969 stocks in this one, and it loads them all. And what I can do in a click of a mouse here, a little mouse click, is sort them by whatever columns I want to put up here. I have next earnings, I have market capitalization, and this is percentage gain or loss for the day. And so what I'm noticing today is an unusual, especially with the markets being, we were positive earlier in the S&P and NASDAQ. We're only down very slightly. I'm looking at another board. I'm looking at the futures. The S&P futures are down 0.18%, and so is the NQ exactly. They're tick by tick right now, both down 0.18%. The RTY, the small caps are down, the futures 1.25%. So it's a pretty big disparity. I've seen that before. Small caps are inherently more volatile, but what I want to show you is what I just showed you here. A lot of these guys are just getting annihilated. And, one of the things I've been watching, remember that the small caps are more sensitive to interest rates than large caps because they're smaller companies. Their credit quality isn't good, so they're more dependent on borrowing. And so higher rates are obviously bad for them, and lower rates are good. Now, they should have been rallying, in my opinion, a whole lot more. It seems like everybody, the big fangs, Apple, Magnificent Seven, they've been exploding since the Fed decided to, did what we knew they do, held rates where they were, held steady. Earnings, of course, are out of the way. But the small caps are sucking wind. Again, you have the technical levels to watch, but we're going to jump down here and look at some of these. And so again, I am cherry picking this in the sense I sorted the list by biggest gainers and losers. But as I go down, it seems a lot of companies, just like the bottom's falling out today. This one's down 70%. FTC Solar, EXFY down 37%. And again, not just down that much, but down to this guy. This guy's in penny stock fill. It'll be delisted. If it can't get back above $1, it's going to get delisted. It will no longer be in the Russell 2000. It's not going to meet the inclusion criteria. EXFY, another one headed probably towards penny stockville. Flirted with it, hit a low today of $1.52. And again, you just look at the chart. These aren't, again, if I saw this stock down 7%, but yet it had gone up 500% in the last year, and it's just maybe overbought in a correction. But when they're getting down to this level, and all of a sudden you have, a third, or in some cases half of the market cap being wiped out in a day, tells you there's some real problems, that these companies may be going away, going bankrupt, or something coming up. They're running out of cash, maybe have to do a secondary offering. I don't know. And I haven't looked at the news on it. It doesn't matter. Again, I'm just seeing a common theme today. 36% UONE, Urban One. 37% down. And you can see the symbols in here. FLYW, that's a warrant. SNBR, Sleep Number Corporation. Another one, 26% down. So I go down the line, and again, I showed you the list. There's just a lot of companies getting taken out to the woodshed today. In this one earlier today, I turned off all my trend lines. I had a trend line this morning. It was right here. I started to notice this morning. It was a trend line support. And you can see it's just since then I drew the trend line right here. Took it out, and it's just a lot of waterfall selling in some of these. And I don't know, maybe it's being talked about on TV or somewhere else. Maybe it's a one-day thing and these guys snap back tomorrow. That one had big support there and it broke. But again, I'm seeing this is another collapse, an outright collapse of a lot of companies, quite a few. And again, there's almost 2,000 companies in the Russell 2000, but I'm clicking through this in order, and you can see a lot of these companies just getting taken to the shed. There's our new multi-month lows. Some of these are new all-time or multi-year lows. And so we'll just add it to my yellow flag list of things to watch. I mentioned a lot of regional banks are in IWM as well. So I'll wrap the video up here. Just look at KRE real quick. I've also sorted that by the biggest losers on the day. You can see there's a downtrend line here. Fairly well defined. I could tweak it down to there, but this is how I had it, because there's a couple reactions there. So either one, if you want to do that, then we're back testing right now. I'm talking breakout here, back test. If you want to leave the one I had it on, the back test is currently failed. And there's also a gap that was backfilled, but now it's been overfilled. In other words, there was the bottom of the gap right here. We're right on it. So again, I don't want to split hairs, and I always say if you have to squint, then give it the benefit of the doubt. Let's just call that a gap, a backfill, and let's call it a back test of the trend line. However, if in the coming days, again, something to watch, we move down, and then that means this whole breakout has failed, aka that's a bull trap, false breakout. Why do they call it that? Well, as the name implies, bull trap traps bulls. They tend to buy the breakout of the trend line. They go long, and then their stops, as they should be, are below there if the breakout fails. So then all those stops get hit. When a stop gets hit, that's a stock being sold. That brings the selling pressure in. And then on top of that, the sharks, aka short sellers, smell blood in the water, and then they jump in and they start shorting, i.e. selling. That's what happens when you short a stock. You're selling shares, someone else's shares. You don't own them. You're going to borrow them, sell them first, and then turn around and buy them, hopefully at a lower price later to close out the transaction for a profit. So one to watch. These are just what's the ones that are down most today, but that really doesn't mean anything. You'd have to go through the list of all the regionals, see the ones that are at. As I'm clicking this is how I usually look at charts when I'm going through a lot. I just go fast, see if something stands out. That one's just back testing now. So again, not a red flag to me, but a yellow flag. And again, something worth monitoring because a lot of, it's just down after a breakout. Nothing wrong with that. Nothing goes up forever. This one, I would draw a downtrend line, probably something like that. And maybe come in and capture that trend line. Yeah, right there. So, like I said, watch it. If these regionals continue to fall much more than where they're at today, the breakout in the entire sector, i.e. KRE, the ETF that tracks them, then will have failed. And like I've said in recent videos over the last couple months, there's not, well, it used to be none of these regionals were deemed too big to fail. And then all of a sudden they were when Silicon Valley Bank, and we had a couple of the big ones that failed earlier in the year. Then all of a sudden the Fed deemed them too big to fail. And as I said, individually, but putting that aside, individually, any one of them really shouldn't be that big a deal, but collectively they are. Very, very much are. You put all the regional banks together, the majority of the commercial lending is done from, regional banks. They're very important, again, collectively. And as a group, collectively, they've all been moving down. Collectively, they're all not too far off multi-year lows right now, which puts them in a precarious position. So again, something to monitor. Also something that will either put pressure on IWM, the Russell 2000, or give it a bid, give it a little wind behind the sails if these guys can rally going forward. All right, I want to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.